Hi and welcome to this monthly wrap up. That we're starting this month onwards. So every month we'll have a guest on with us. This week we have a very good friend and keen observer of markets, who's observed the markets for almost 30 years now, from his perch at ET Prime and various other publications. So my very good friend Pravin. Pravin, welcome.
Hi, hi.
Is that your cat jumping around?
No, 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 no. The cat is not here. Somewhere around.
So, Praveen, a lot of things are happening in macro. This year is sort of turning out to be the year of macros than micros. It's
Yeah,
like some years we say it's a stock pickers market. This year it's turning out to be, a federal or a central bank driven market.
yeah,
So,
yeah.
there is this concept of moral hazard and central bank will come rescue you, come what may. You can just the bankers can do whatever they want to do. So, is that something that you've been seeing over the years, or what do you
So,
think about
so Anish, actually, see, you were the first one to flag off this issue in one of our articles that you did for ET Prime, where you had talked about this, especially because the whole point was about QE. So you had said somewhere that QE1 was needed and QE2 maybe to some certain extent QE3 was required or not. So we have been talking about the central bankers. I mean, you have been talking about it in our articles, and I think sometime in December or November we realized that now this game is all macro. I think with this Ukraine Russia war happening and the spikes of inflation, and we just kind of realized that now this entire game has now gone to the central bankers, and it looks like even for the next 1 year, or if not maybe more actually, the central bankers can decide the fate of the market. But let us look at it this way: the last whole decade, the central bankers have decided our market, actually speaking, because they just kept the interest rates low, and that has just brought the cost of capital has been low for companies. Especially this has helped the software companies, which kind of have, or tech companies, which have kind of shown some of the best results over the last decade. So this has actually been a decade of central bankers play in taking the markets going up. Now the central bankers are now acting exactly in a reverse way, and maybe they're forced. I mean, like act in a reverse way. So clearly, this is not a game of finding that right stock, or finding that right fund manager, or finding the right fund to invest in. I think clearly what we have discussed is the only thing that has mattered to the market actually. I mean, like since eternity is interest rates, and if there is one central body that is deciding the interest rates, then that particular body we have given a lot of power. So we are looking at now what is happening in the UK, what is happening in the US, what is happening in the developed world per se. So I guess clearly the central bankers are the guys to watch out for. I mean, how
yeah,
do you look at it? I would love
yeah,
ask you.
yeah. So I think Greenspan perhaps, who has been the longest serving Fed Reserve governor. I think he was at heart really a true believer in capitalism, and he believed that markets would set things right, and bankers have the incentives. As long as you have the incentives in play, the you just need to step in a little bit and push things along a little bit, and people, these excesses will get corrected over a period of time. But that unfortunately has not happened. I think he got away with it a couple of times in the 90s, where he sort of tweaked and that, but maybe perhaps he didn't clean out things as much as he should have after the dot com bust. So I think after the dot com bust, I think they kept things way too low, interest rates way too low for a much longer time, and then that led to the 2007-8 subprime crisis, and till today we are living in that giant macro experiment called quantitative easing over the last. So this is actually born of the dot com excesses, and we are just that it's a 20 25 year
So,
cycle we're living in.
so what Greenspan did was actually not wrong. I mean, he really had faith in humanity. Okay, but
Yeah.
he should not be having faith in bankers. So humanity and bankers are driven by totally different incentives. So maybe I think Greenspan kind of confused his intentions, and he was not really able to get inside the mind of the bankers who he thought that if he would have given, if kind of like that entire risk reward ratio in the head of a banker is very different than than from how Greenspan was probably thinking about them, because he generally genuinely believed that that they will take care of themselves.
Yeah, but that clearly didn't
Yeah.
happen, and the bankers are like just handed him the when things were going bad, and now look who we had the head of Goldman Sachs as the Treasury Secretary when things went went south in 2008. So obviously he was
Yeah.
uh, I wouldn't say sympathetic. I'm pretty sure that I mean, he let Lehman go, so even some people say that that was due to
Yeah.
his aversion for Lehman and whatever. But it's very hard to sort of have any proof about all of that. Conspiracy theories
Yeah.
is, but yeah, he realized what happened, what he was sitting on when he let Lehman go, and
Yeah.
then I think he just had to go the other way. He had to, uh, get the bazooka, which he promised not to use, and then
Which
he instantly used. He just so basically it was a simple bait and switch. He just sort of got Congress to approve, and then he just went across. So and then then came Bernanke. Bernanke after Greenspan, he sort of saw. I mean, the depression was his thesis, right? His economic thesis, PhD thesis. So that
yeah.
he had almost lived that era through his education. So he didn't want a repeat of that. And then we got Yellen, and Yellen was again, she handed off the baton to now Powell. So Powell was also, I mean, now people are sort of making a virtue out of our central bank's inability to give QE when COVID hit. So I think now you're seeing India is standing out in this current mayhem. But the truth of the matter is that we had no ability to give a cash stimulus, a real. So we got a 20,000 crore kind of package. There was no real cash which was going out, which in hindsight turns out to be a good thing. That
Yeah.
we had to fend businesses to a large extent had to fend for themselves, and overall it's turning out to be much better. So not that India has decoupled or anything of that sort, but the extent to which markets were depending on. Let me just show you this report of CLSA and share it, where the testimony of Powell is there. So they're still
Yeah.
asking him, when will you slow down?
Hmm.
And they just keep believing that someday the Fed is going to pivot, and the things are going to go back. I don't think US markets as well as Indian markets, markets globally have they're still hoping that you keep hearing these things that, oh, the Fed is going to pivot, Fed is going to sort of, we've reached. And this time he's really going out to give his message, because a lot of inflation is, it's not just about interest rates, it's also a lot about psychology. Because if you believe interest rates are going to be high in the future, you as a, I mean, as a worker or as a business person, you're going to go and ask for a higher wage from your employer. The employer is going to increase his price. So it's actually a lot of cycle or behavioral finance that goes on in managing economics,
Yeah.
in managing the economy. So this time he's saying that we are only when we are very confident that inflation is moving to 2%, that is when we will move. And I think that's what sort of again caused a shift in US markets. And we've broken June lows. And so yeah, there is a bit of that mayhem that's sort of
Yeah.
out there now. And we saw a display of that in the UK markets, where the pound went to. So, again, another Indian got it right this time. Last time it was Raghuram Rajan, who
Yeah.
had won, who had at Jackson Hole, who had warned that, in 2 years we'll have a problem.
Mm.
And this time it was Rishi Sunak who said that if UK goes ahead and implements what Trussonomics is what they're calling it now, if that is implemented, yeah, UK is going to be in big trouble. And again, that's the case.
The market has already reacted to that.
Yeah, yeah. So you're doing the pound was in a free fall. The guilds crashed. Now, of course, the government has had to again step in and again rescue.
Mm.
So it's becoming a very, and it's one of the reasons why again trend followers have not done well over the last
Yeah, yeah.
8 years, is because natural trends in commodity markets or currency markets or bond markets have not been allowed to continue. Basically, volatility has just been dampened,
Right.
and people have just not been allowed to sort of a trend to continue. So that's one of the reasons I believe why that trend following is also trend following. When I say trend following, not the trend following we see in India, where somebody applies some one formula to an index and calls it a trend following product. Trend following is like when you're
So,
following.
So, Anish, I mean, I just saw a tweet which was very interesting. So, some guy had tweeted that, if I want to buy a Rolex watch in US, I rather, fly first class from New York to London, go there, buy a Rolex. I can basically stay in a five-star hotel for 2, 3 days and come back, and I would have still be spending less for buying that Rolex when compared to buying it in New York. So that is the state right now because of the fact that the pound has completely crashed. So looking at it, I think what we I think let's come to just two things, what we are experiencing. Like my first thing that is something that comes to my mind right now is that, so we have this macro situation, and we also have a 2 year bull run where we have seen the market kind of going up, and that has attracted a lot of retail investors who have looked at these 2 years returns and have come to the market. Okay, now first thing is like their expectation management. Okay, I don't think they are going to see the kind of returns that we have seen in the last 2 years. Okay, so I was just kind of wondering that that so many investors have come into the market. Like what should be the realistic expectations that they should be setting in. So we have seen that when the markets actually crashed in March 2020. Okay, we thought that the whole idea was that the world has come to an end. Okay, then there was a clear uptrend, and then the market was more or less kind of on an uptrend, and now we are seeing that a whole lot of new investors that have got into the market. Okay, and this entire macro scenario playing around. Okay, it's something that for most of them, they are just not used to this world. Okay, now the UK pound is crashing, the Indian rupee against the dollar is falling. Okay, emerging markets, actually speaking, have not done actually very well throughout. Actually, we have seen that India has actually managed to do well, and that India managing to do well in a very in a world that is like more or less not doing so well. So we are actually having very expensive market. So now when and you have S. Naren talking about the fact that I'm so happy about the fact that the Indian market is up because of these retail investors who have come into the market, and they have supported the market at a time when financial institutions, the foreign institutions are not present. I want to understand that how should their expectations be from here. Okay, this is something like I remember like many times we have discussed that. The retail investor is actually the last straw. When normally they come in last, and they're the also, like, many times before a bull run they also exit. And I also, to a certain extent, we also argued that the retail investor also getting smarter if I compare it to him, say, 5 years back or whatever. Now I just want to understand that how should they be now? How do you look at them? How they are going to behave now as a bunch? I'm talking about, and be honest about it.
Sorry. So I was reading Stan Druckenmiller. Again, his interview few days ago in CNBC. So he was again asked about his famous pound trade of 1990 when he was with Soros.
Hmm.
So he brought about this contrast, saying that in 2020 it was a very short-lived. I mean, people didn't even have time to react. It
Hmm.
was so quick in and out the market in 2 3 months. So now, in a situation like we've been in there for the last 1 year, I think I would say that the Indian retail investor has actually done has been actually fairly well behaved in terms of not discontinuing their sips. I think they have continued it. Had they not done that, I believe we would be far lower given the amount of FI selling that we've seen in the last year or so. And now the trouble is that is there, like, there's CLSA report that's just come out a few days ago,
30%.
which talks about the difference between the US bond yield, the Indian bond yield. So the US bond yield has gone up by almost, I think, 250 basis points, whereas the Indian bond yield at the same time has just gone up by something like 50 basis points or something. And the gap between the two has never been so close. And we are again at a situation where the inflation in US and inflation in India has never been so close. And if that continues, if that continues, I think the Indian market is overvalued at this point in time. I mean, pockets of it, I would say. And so US markets in that sense have broken the June lows, and gone below that. But we are yet to go back to that number of 15,500, 15,800 kind of number. And from there, then when we if you see this chart, this is the 10-year GSEC minus the US 10-year Indian 10-year minus the US 10-year. So you can see it's at a all-time low,
Yeah.
the differential.
Hmm.
It's never been so
This
low. The
low.
only time we saw it just so low was in '08,
Hmm.
'09, and we sort of seem to be going back there. And
Yeah.
this is what they are trying to say, that is it decoupled. So I mean, we last 2 months when we were doing fine, everybody had got into this decoupling story. That, oh, again India is decoupled. I mean, they decouple and decouple faster than Scott McKinsey divorces and gets another husband. I mean,
Yeah. Yeah.
so,
So,
I mean, yeah. So Indian markets can never be decoupled. What we can be is the equivalent of an FMCG in a global fund manager's kitty. That, okay, we'll fall less than the others. Maybe we'll fall, but if
yeah.
US,
Yeah.
UK, developed markets
Hmm.
fall, there's no way that we will not fall.
Yeah, but I guess, like, yeah, I mean, in a falling market we are low beta, and a rising market we are high beta. It's probably. Uh,
Yeah, if that happens, I mean, that's the best case scenario.
hmm.
If that happens, that's very good for us.
Hmm. Hmm. Hmm.
But
Hmm.
if that does not happen, then we are then and if this pocket of there are still stocks at 100p. Some stocks are still there at 100p. Now,
But
if those stocks,
some fund managers are arguing that we should not look at PE anymore. I mean, these stocks are
that is a
different.
different that will take a long time to cover. But that aside, the market is now starting. It just see. I think like Druckenmiller Miller said, this time it's a very slow crash. It's happening very very slowly, uh, and these and it can, for all you know, it may just be like a real estate market which just goes sideways for years and years and nothing happens. So these stocks can also, maybe they don't correct, like the from 100 they don't go down to 50, but they, even if they stay at 100, between 90 and 100 or 80 and 100 for the next 2 or 3 years. I mean, Dr. Miller is saying for the next 10 years we'll not have any returns in the US market. We are just talking about about a couple of years. That excess will just get swiped out by a sideways market, and then people get frustrated, and then all these people who've come to markets using different routes, who want to trade every week, who want to rebalance portfolios every intraday and every day. Then sometimes they say every hour. So they they want. So that's also a side of the market that that has gone away. That Robin Hood army in
Yeah,
India.
yeah,
So the Zerodha army in India, whether that is still there or not.
yeah. No, I think so. So those traders actually, so we don't know whether they actually make money or not. But I guess that excitement of, in those traders is still there. Like so I would not I would not say that they have gone out of the market or something like that. I think those guys would be there. They are in any way they are. Derivative traders. Okay, they're like
Yeah.
for day trading. So I guess they can always say that मेरे को क्या फर्क पड़ता है where the market is going. Okay, but I hope they are making money even if the market किधर जाता है उससे फर्क नहीं पड़ता है. So I completely understand like where the these guys are coming from, especially these derivative traders and all. The main
Yeah.
thing is the main thing is that someone who is entering the market right now at whatever the P is, like whatever I think the Sensex is what 22 odd P or whatever, like yeah.
Yeah. So, somebody's asked a question, adding to your question, saying on the basis of recent trends in capital, this is Vineet Jain. So, he's asking if I may add to your question. On the basis of recent trends in capital markets, what should be the learning for the retail investor for the next 12 to 24 months?
So, so clearly, see, this is something that all of us are personally grappling with this entire thing.
Yeah.
So the last 24 months, that has happened already. It's an event that has happened. Okay, and the next 24 months, ideally, we should not now connect that, because the world has completely changed since then. From what I understand is, you keep on investing every month. Okay, that's the simplest thing you can do because nobody knows where we are headed. Depending on your risk appetite, I think you should just, if you're like probably like investing 1 lakh rupees in the market earlier, maybe you can trim it down a bit based again on your asset allocation or how you look at your own personal risk. That means like it is like if you probably would be having a home interest or an EMI to pay or like fees to pay and all that kind of stuff. And see, it's slightly an uncertain market. It's a costly market. So obviously you have to bring down your SIP levels a little bit. Okay, but the answer is you have to invest. I mean, I'm talking about the investor who is looking at least more than 5 years. Okay, so that is what 5 years. So we are talking about around 60 SIP amounts that you will have to pay. And I think 5 years is also actually less because the cycle might just last longer. Because suppose if the next 2 years remain flat, okay, or you get like you get hardly 4-5% return in the market, okay, then I think you'll have to even look for a longer term of doing your SIPs. That would be actually 7 years. So I guess like you should be just ready to invest for the long term. I mean, like I know it's cliche. I sound like one of those records that we hear on business television and all, but sadly they are right.
Yeah, but so basically, get your asset allocation right. Ensure that you keep your expectations low,
Yeah,
and go about your day job, and just focus on that. So
yeah,
make your money from that, and keep investing and create your
yeah,
wealth from that. I think
yeah.
that's the way to go. I guess you can't. I mean, it's see over the long run, returns always reward to mean, right? So if we have got excess returns in the past, we will get expected returns in the future will be much lower. You were looking at Ashwath Damodaran's equity risk premium, right? So what was your reading of that?
So, so he says that ERP is like at 1997 level. So there is so much scare in the US market. Okay, now you really can't compare that with the Indian market because in general risk premiums in India are high only, like in general
Yeah,
compared to the US market. But see, I you see the problem is that even his methodology is not capturing the Indian ERP. Okay, that's something that we don't have a standard ERP to look at. To compare, like the way US can, like present ERP can just completely compare it with 2008, or you can go back to 2000, or you can go back to 1997. We do not have a standard number like that. So in such a situation, what we probably need to just look at our bond yields plus and our past market returns. This guy Damodaran does give the Indian ERP, but that is, I think, on a 3 month or 6 monthly basis. Unlike for US, he does it on a very regular basis.
yeah,
So,
yeah.
I think we should have that standard number for us to actually fear gauge. Like I think maybe you have an idea. Like I mean, you in the sense that if you we know that relatively I mean, risk premiums are not that high for the Indian market. Obviously, they are not that high because I think the expectation from the market is also fairly much better, I guess, in the near future. I don't know how you are looking at it.
Yeah, so I think we're just going through. Okay, let's just look at it. Sector wise. So IT clearly is taking it. Taking a hit big time. It's down this year about again down 30%, and small caps are again down 15 to 20%. So
Yeah,
that risky part of the market is not. I think ironically the risk lies in the large cap mega cap space now, and a few of those not getting stock specific, but few of those new age companies which are doing well right now, catering to consumer space, catering to those space, which again, that those defensive ones probably are in a bit of a expensive zone. But so I think next 1 or 2 years will actually be more of a trading market, sideways trading kind of market, than where you will see a buy and hold investor actually making too much money. I mean, I could be completely wrong, but
no. So you look at it this way. I mean, like all the new age companies, like since they don't have much, or they don't have profits or whatever, on a price to sales basis, they are very high. I mean, like say something like a Nika is also a price on a price to basis, price to sales basis is around 15 to 20x. Okay,
yeah.
and you get DMart at 8 to 10. Okay, so that just says it, right? I mean,
Yeah, so that is
the
a sector where that people are like, they may downgrade a little bit, but it's not that we are going to stop using these products, or
yeah, yeah,
are going to stop using FMCG products, or beauty products or things like that. We're not going to stop driving cars or anything of that sort.
yeah, yeah,
So, all those things will not happen. You may downgrade a little bit for whatever it's worth. You may push back on your car, on your big purchase, or you may sort of say, okay, I'll upgrade my car next year, or you'll spend a little less if inflation is pinching you a lot. So, that is perhaps so growth may not be as as it seems on the top line. and you may not be getting that. So I think at least in the venture capital, private equity space, funding has sort of is on hold.
Right.
I believe is absolutely on hold, and people have been told. I mean, we are seeing the layer at least companies preparing for layoffs globally from Facebook
Yeah.
to
Today, Mark Zuckerberg also like gave some kind of a warning. Basically.
yeah. So it's actually, I don't know, and I want to blame newspaper for this. So today I saw the same same. So yesterday there all this story of layoffs and everything, and then today there is a story again of in ET on talent crunch. So what is the real? I mean, both can be true in different industries, right? So I mean, I'm not saying that they both can't exist, but at a macro level, are we going to see job cuts, or are we going to, or is it that talent is not available, or is it like both are true?
No, I think the software guys have paid a lot of money, and now they are sudden to their employees, and now suddenly they are realizing, यार इतने talent के लिए इतना ही देना चाहिए types. So I guess
But
like
they're not
they are
even coming back to work, right? That's the office leasing I saw today, that Paytm is not taking its expanding.
yeah.
Amazon had taken space. They are not taking the additional space that they thought they will take. So a lot of people are not returning back to work. So if you're not going back to work, how has your work life changed post COVID? Like, how many times you used to go to office, and or how many hours did you spend in office before and after? But I mean, being a journalist, obviously you go out and meet more people most of the time. But uh, but uh, has the work from home sort of hybridization of workspaces like really taken deep root in this country?
At least in our industry, it has. I mean, like most of us, I know for a fact that we are not going to. So there, there was this entire concept of a newsroom. We have
Yeah,
seen it in television shows, or we have seen it in cinemas and all that. That there is this very buzzy office where, like, someone is doing something and there is like a lot of noise, lot of talking going on and all that. So that was a completely pre-COVID era. Now post-COVID era, uh,
yeah,
only if it is really essential for you to go to office, people are going for that one particular meet where it is really important for you to meet. I'm talking about the office meeting, okay? But
yeah,
we have kind of figured out that this entire setup can work. Like, earlier it was like the desk could not imagine that, they can actually do a layout of a newspaper by sitting at home, okay?
correct.
Now it is actually happening. I mean, we are not going to office the way we used to. I mean, like so many of the centers are operating in a way that someone is working from Mumbai, someone is working from Delhi, someone from Pune. So I guess the newspaper industry has figured this out very well. And unlike the banking business and all, where, like, there are certain inherent risks by keeping a person work from home. Kind of a guy can do a lot of interesting things. Like we saw it in Axis. Actually, one of the things that Sebi
Yeah,
said, that people should be called back to office
yeah,
because there is no control on them when it comes to any kind of passing out of
yeah.
information and all that. There is no control. So to
Yeah.
a large
In
extent,
BFSI, I think I was reading the numbers. 80% of people are back to work from office,
yeah,
but
yeah,
there is still, like, people like me. My habits have changed a lot. I can, like, first off, I completely work from home and I'm doing everything in the morning.
yeah,
Get up, because, and then second half I go to office and work from office. So that you get to spend time with the children. You get to do all of that. So that I think that that kind of life has really changed and not getting back. But coming back to markets, Praveen, you made a comment, you raised this thing about ESG today, and whether we should, for whether ESG is one more mandate that should be, for lack of a better, थोपोड on fund manager कि now अब तुम ESG भी संभालो, EPS भी दो और ESG भी दो.
yeah,
Don't
yeah. So,
worry.
so I will tell you how. So, many years ago when I was working with Forbes, So I met one fund manager. Now he's a very big guy. Okay, he's a very very big guy. Okay, and he told me that that if I have observed the data, okay, that companies that are clean on an ESG basis, they also have a higher EPS. Okay, I'm talking about 2013, 14 times. Okay, that kind of era. Okay, and I said, yeah, okay, hoga. I mean, like if you say so, okay. And I mean, see, he was thinking on a very logical lines that अगर एक company clean है, I mean, okay, that also means that it will eventually give returns to the shareholders. Okay, it's basically fundamentals are going to be solid and all that kind of stuff. And he showed me data about you look at the top 100 companies, look at their growth rates, look at their ESG scores and all, and more or less right in the sense that if you look at the top 100 companies in India, okay, they have a decent ESG score. Okay, so okay, I mean, like, because what happens is, like, as a company becomes bigger and bigger in size, okay, in general, there are always some external controls that come in. Okay, just a minute, I'm just putting on the light.
Yeah, yeah. I was just going to tell you that.
Okay, so what is happening with people is that there is this whole thing that people are forgetting that a corporate's job is to drive its EPS. It is that vehicle or that thing is created to earn profits. Period. Okay. It exists to give returns to the shareholders. That's it. Okay. Let us not complicate. Okay. Complicate the job of a CEO. He is given his job is to allocate capital and generate high ROC. Okay, so now that part you keep aside. Okay, now if he is doing something wrong, okay, which could be in the nature of something that is criminal, okay, then that is criminal. Okay, let us not get there. It is
Yeah,
wrong. It is wrong. But a lot of the things are somewhere in between. You cannot really say that it is criminal, or you cannot say that it is right. Okay, and that is where you need to have systems. Okay, that should exist. Okay, outside the corporate ideally, because the corporate everything is covered, because there are many laws to cover what a corporate can do, what a
yeah,
corporate can't. Okay, but you need to have some systems or institutions, okay, out there, who will give a rap to the company, or who will pull up the company, okay, for a particular decision, or yeah, you are polluting that river, okay, and uske wajah se these people are kind of getting hurt or whatever. So then someone should be there, okay, because
and those things are already there, no, in some sense, like in terms of say chemical companies, you have
but that
uh,
is criminal. That in many cases that is criminal.
yeah,
So it
you
is very
have
easy.
effluent norms, you have pollution norms, you have you need to take the pollution
Ah,
control board is there. So all those things are there. Here it is more saying that you go out of your way and
एग्जैक्टली
sort of
तो आप संत बनो बेसिकली व्हाट दे आर सेइंग
uh,
आप सेंट बनो अगर मैं सेंट बनूंगा सो व्हाट यू आर सेइंग इज दैट इफ आई एम पॉल्यूटिंग अ रिवर so there is a law यार you
well,
cannot
yeah,
pollute.
yeah,
It
yeah.
is
And
black and white. It is
governance
black
is
and
also
white.
taken by most people into by any stock picker. He will look at the governance of a company while picking a stock. Bad management or bad boards will obviously get penalized. I mean, there's a reason why some banks get a very high multiple, where versus other banks don't get it. So that governance part also is somewhere already there. Now, if you
It's there. It's there. It's there. It's there. I think we are putting an extra layer. Okay. Okay. Which basically is. I mean, like, see, I also believe that there are some genuine people who care. I care for the environment. Okay. Now you will say, if you care from the for the environment, then how are you having this kind of, like, extreme libertarian views? So the thing is, like, I believe that these two things can go hand in hand, in the sense that you cannot, because the objective of a company is to drive in the EPS. There are laws to control if the company is doing something wrong, but you cannot put a layer on it saying that,
Yeah.
now you be ethical. Okay, I
It's a bit
don't.
like the the laws of the game and the spirit of the game.
Yeah,
Like
yeah,
we
yeah,
saw that controversy a few days ago. The law
yeah,
exists. You can run out the striker at this end. Now you're in the you violated spirit of the game. Up,
yeah,
then
yeah.
you change the laws. No, I mean you
No, no,
can't.
no, no. I will come to one more point out here. See, when a company is small, okay, now that is there for India and that is there across the world, okay, and it is trying to grow, okay, so it will try to take some shortcuts, okay. I don't think there is
Yeah,
any country in the world
yeah,
that will say that यार मैं तो पूरा time clean था. I mean, like, and I managed to become big just by becoming doing that. So I think it will take some shortcuts, but as the size of the company starts becoming bigger and bigger, the eyes watching that company also increase, okay, in terms of
yeah,
institutional investors, in terms of watch lawmakers, in terms of government, in terms of even retail investors, in terms of activists, in terms of environmentalists. So as the company starts becoming bigger and bigger, the eyes that watch that company also increase. And what happens in the course, as you get bigger and bigger, the company actually realizes that, okay, now there are so many people watching me, okay, I need to now, यार उस टाइम तो ठीक था, उस रिवर में मैं केमिकल्स डाल दिया, बट नाउ विथ माय साइज एंड ऑल, I
yeah,
mean, I will come in serious trouble and whatever, whatever. So what I'm saying that ki most companies, okay, would not do it only. Like, firstly, I mean, like,
yeah.
they will not do it only. But yeah, that for that extra, if I'm 1% extra ROE मुझे मारना है, and I decide to cut the corners, then there should be an external watch that should be taking care. But you cannot force the CEO to actually take that extra mile, because that is not his mandate. Okay, his
Correct.
mandate is to deliver the ROE. Okay, his the mandate is to
And
deliver
actually,
the
Eugene Farmer actually was asked this question, I think, a year ago in his Chicago, one of the Chicago interviews. So he said, ironically, you will be worse off if you force this mandate on stock prices and of companies and of the CEOs, because look at it this way, you as a person who cares about the environment you will shun a stock which you don't like, and you will sort of herd towards the stocks that you like, which you think is doing well for the environment. So what happens, you sort of push the stock higher, that stock gets overvalued. If it gets overvalued, its cost of capital also, because the expectations future expectations also become higher. So in a
yeah.
perverse sort of way, you are not serving. Let the capital market do its job of pricing companies correctly on the basis of their cash flows, and don't put that ESG mandate. The ESG mandate should be on the government, on the lawmakers, on all those kind of. But it has become a big thing today. That's, I mean, for better or for
No, you
worse,
look
it
at
has become.
you look at all these coal companies, or basically energy companies, and
Yeah.
in between, we were very so strict about them, and now we are suddenly realizing that, when the world is, like, going into a
Yeah,
very
we all
inflation.
under invested in fossil fuel, so now we are sort of understanding.
So now, so I think, I think, so at the same time, I feel that, the environmentalist उन लोग तो आवाज करना ही चाहिए. Okay, I'm not saying
That
वो
is
करना.
separate.
नहीं,
Yeah,
नहीं, वो
because
प्रेशर रखो आप, you keep the pressure on the company. The
yeah,
pressure should not uh, you know drive the companies, okay, to basically to screw up. You know what I mean to say. There
correct.
is, so you know what I mean to say. I'm saying that there should be pressure on the companies to behave in the right way, but it should not, that pressure should not be so much that तू ये नहीं करेगा तो तेरा इन्वेस्टर्स चला जाएगा, या
Yeah,
ब्लैक रॉक कमिंग डाउन एंड सेइंग दैट, ओके, यू आर नॉट फॉलोइंग these norms, then I am the biggest investor in the world, I am going to get out. Okay, so
correct.
I think the pressure should be there. There should be institutions to kind of look at these companies. There should be environmentalists who should go do their morchas and whatever, whatever, whatever. I think the worrying part is that the shareholder should not participate in this. Sounds crazy, I know. Sounds
Yeah,
crazy, but what I'm saying is let the other guys do it, because again, like we discussed, it is their job to do it. But a shareholder cannot say, I want to have a clean company and also want a high ROE and also want a high stock market return. Okay, these three things can't go hand in hand. Okay,
correct.
then you go on the street and basically then you don't participate in that company as a shareholder. As a shareholder, you cannot force the CEO to be. I mean, वो कर रहा है on his own to be, because I believe that generally most CEOs will try to do their best to, to be environment compliant and all, because they have that pressure from institution activists, AO
Yeah,
sub. This extra investor pressure is a bit, can be avoided.
correct. But now this is leading to another trend in terms of custom indexing and direct indexing, where it's saying that okay,
So
I want this basket, but now remove this for me. Give me
so
a tilt where you are rewarding the ESG, somebody who's scoring high on ESG, and remove somebody. Ironically, Berkshire scores are very low on ESG because of
yeah.
all the fossil fuel investments and all that it has.
Yeah. So I guess, like, so I guess now everybody is now tuned into what is indexing. Everybody is tuned into what is ETF, and I guess, like, the bulk of investing is now coming into the mutual funds business, even in India, through the passive route, and that's really cool. But yeah, now what next is the question, right? So the next question is that, how do you take this forward? That investing to मैंने कर दिया. I guess this entire thing about direct investing and custom investing, maybe if you can elaborate that part, okay,
Yeah.
about both the directing and, more importantly, the custom indexing, which I think we have talked about, that is going to be the next big thing in town. Actually, that would actually be, that would be an index funds on steroids, actually. So you should be taking that question about differentiating and actually getting more in the details of custom indexes.
So actually, it's not really a very new thing in the US. I was surprised to hear that companies have been doing this in the US for almost 30 years now, and that for somebody who has a account size, say over a certain number, for them. So again, you have to go back to the evolution of mutual funds. So mutual funds are not actually built to sort of beat a benchmark. They were built for owning a portfolio of stocks because brokerage costs were very high, and you could not invest a small amount of money if you had to buy 500 companies, right? You could not. There is no concept
Yeah,
of fractional shares and things like that. So because of those reasons, mutual funds came in, a convenient way to wrap 500 stocks into a wrapper and give that to the investor. Then came in 1976 Jack Bogle and the index fund and all of that.
right.
And then the mutual fund said, "Ki, okay, now what is how do I survive?" Then they said, "Okay, our game is to now survive by beating the index, by beating the benchmark," and that is how active mutual funds sort of changed their mandate from being a convenient way to own the market to actually trying to beat the benchmark. Now again, it's sort of going towards. So in those days, also, if you read those books on Trillions by Robin Wigglesworth or the Bogle Effect, so there were these large pension funds and large corporates who used to do indexing, but in a sort of a PMS, which is called a separately managed account in the US. They used
Right.
to own. Uh, so now, for example, if you want to replicate a large index, say like the Nifty 50, you don't actually need to own 50 stocks. 30 stocks account for almost 80% of the weights, 25 to 30 stocks for
Yeah.
85% of the weights. So if you own 25 stocks, you will be able to replicate the index performance far
Hmm.
better. Then in that, if you say that okay, now I work in media, for example, or I work in an IT company, don't give me IT exposure because I'm already too much. I have too much of that. So I'll just show this sort of graphic, which just shows. just a graphical way of showing that it's just breaking up the index fund into its components, and then you can sort of say that, okay, um, for can you customize it for my personal situation? Some people are worried about tax, so there is this I mean, again, controversial topic about tax loss harvesting. Some people say no, no, it's worth doing it. Some people say no, it's not worth doing that. All that, why would you buy some 50 stocks and then try and manage it on a weekly, daily basis and do it all that? But the truth is, today we have the technology to do it. So if you want to save, say 1 or 2%, if in certain cases you can, why not do that? So I
Right.
think, or like ESG, for example, people saying that, okay, can you put an ESG tilt or screen onto this, and
Yeah.
screen out companies which don't comply. So I don't want to buy tobacco companies. I don't want to buy alcohol companies. I don't want to buy casino
Fair
companies. So
enough.
it's just the rest. So there are different ways now to do that, and with technology, I think that is sort of becoming. I don't know whether it will become a big thing in India in some way or not, but at least in the US, I think it's become fairly big. And in the last few months, there's been like a lot of what do you call M&As, where even Vanguard, for example, Vanguard has purchased a company in direct indexing. Vanguard has actually never, I think, or has rarely makes any acquisitions. So
Yeah.
Vanguard has now bought a company which is into custom indexing. So this is the map in the US, where the landscape in the US, where Goldman Sachs, Fidelity, Morgan Stanley, Charles Schwab, BlackRock, Vanguard,
Right.
everybody now has a direct indexing or a custom indexing offering. So I think it maybe in India, it will be a good way for say the RIAs to differentiate themselves, saying that this is how I can custom make it for you, versus giving
Give
you
me a
these five.
quick, Anish, give me a quick example of basically what exactly happens. So I mean, like, so when I buy a Nifty 50 index, I buy all the stocks in it,
Yeah,
and invariably there are 10 stocks that have not given me the return for that one particular year. Okay.
correct.
So what does custom indexing actually do to me, basically? Just can you just
So
kind of
one of
help me?
the yeah, so one of the main use cases of custom indexing, like you said, was tax loss harvesting. So
Yeah.
now you'll let me just again show you this graphic saying that where uh, the in a index almost 50% of stocks go up and down through the year. So on average, almost even in a good year. So, I have not shown you this graphic, but let me just show it to you. Uh, so you can see, on average, even in a bull market, you can see that this red is the component. For example, let's take, the year 2019, 2020, for example. So the index was up 15%, but we had almost 85% of stocks which fell more than 10% that year. So that was a fantastic year if you wanted to do tax loss harvesting, which is basically nothing but book your loss, and if you have capital gains to offset that, then to offset that, if you have a loss gain of 50,000 or 1 lakh or 5 lakhs or 10 lakhs, and you have a notional loss in your portfolio of say 5 lakhs in these stocks, if you had bought it as an index fund, this would get netted off. You would not be able, because there would be winners and losers. But when you are doing it separately, then you can sort of sell the losers one to today and buy it back tomorrow. So you've not
Yeah.
disturbed your portfolio in any way. You've just booked your loss, and you can set it off against the 5 lakh rupees capital gains you have, and you don't pay any tax for that year. Uh,
Yeah.
so in a case like this, that is one use case. The other now that is something that you can't do in a index wrapper, but you can do that
Right.
in a direct indexing. So even in uh, in years in which so for example 2012, in a year in which the market was up 28%, we still had 45% of the index stocks which were down more than 10% that year. or even December, say 2014, we had a return of 31%, but 68% of stocks had a drawdown of more than 10% that year. So we've kept a threshold of 10%. We're not saying if it goes down 1%, we're going to sell. We
Yeah,
keep a threshold
yeah,
of 10-15% on a monthly basis. And if you see that, then you say, okay, you can sort of do that. So that's a quick, quick take on direct indexing and custom indexing. But that is something we'll explore more as we go along, and that's
yeah, yeah.
possible in the PMS format today, with technology, with brokerage costs which are so low, and
Yeah.
with mass customization also, which is one of the
But
features
who
now.
should go for it ideally? Do you think anybody and everybody can go for it?
Not anyway. So if it's, I think ideally if for somebody who's investing over 50 lakhs to 1 crore, over and above that, and even there, if you have situations where you are going to have recurring capital gains, or if you are, say, working in a large IT company or a bank, or where you have a
Yeah.
lot of your ESOPs are part of your portfolio, and your portfolio is very lopsided,
Mm,
then you can slowly sort of have a transition portfolio where you're selling off your ESOPs on a gradual basis over the years, and you will
mm,
realize capital gains from that. Then you offset those capital gains against against the
mm.
loss that you can take in your direct indexing format. And there are special cases in which you can use it, but not it's not for, I wouldn't say it's a do yeah, if you but for the use case like ESG, for example, instead of buying an ESG index, you can just buy an index fund and just remove the ones that you don't like. Or for
Right.
someone like, which is somebody who wants a Sharia compliant sort of
Yeah.
portfolio. In that kind of a use case, you can go in for this thing. Just get me the companies in the index. I want to replicate the index, but don't get me these companies. So but these are very strong use cases, and today with technology, this can be done at a much lower cost. So, for example, the thing that is the advantage of a mutual fund, which is its tax status, where you are not taxed on the amount of trading that a mutual fund manager, or the churning that a mutual fund manager does during the years. That sort of becomes inefficient if you're an ultra HNI or an HNI investor, because then you have that flexibility to take advantage of these tax planning sort of mechanisms.
But a mutual fund in itself is as a vehicle that trades. Okay, that itself can use it basically for its own purposes, but it will not be of any help to the
You can't know, because since there's no concept of gain, there can't be a concept of a loss, because you're not
yeah,
being
yeah.
there's no when on so there is no
They are not paying any taxes in any which way
you
on
cannot
trading.
they're not paying tax on the churn that they do. So
Yeah,
that's
yeah.
so I think it's
Right.
been it's an hour almost now, Praveen. So it's been fun. And I know we have one more last one to do, though, so we should just cover that one. So that is the metaverse and
Astraverse.
the
Astraverse.
Astroverse,
Yeah, yeah.
Brahmastra.
Yeah, yeah. So last but probably the most important question, if you really ask me, is that I mean, it focuses on a lot of things. Like this Karan Johar's movie, Brahmastra, has not done well as per the expectation, and I think they put in around 600 crore, and they were not able to collect the amount that they wanted to. So what really, I mean, like. So a colleague actually called him up and he says that he's not interested anymore now in actually doing this movie. So we just kind of were discussing this, that Marvel actually they released I think around 24 movies or something like that over the last many years in the entire uh, Marvel universe. Okay, with
Yeah.
all the backstories and so many superheroes and all. So that was done with a plan. Okay, and the question that came to our mind was that are we as Indians not really good at taking up really massively mega projects, that can actually, the project can actually span over like say 15, 20 years. Like, can you, are we really, not up to that challenge? Or is it like, a challenge that is basically an operational issue, or is it a financial issue, or both? Or how do we kind of like get over it? So if you really look at this, it's across India. If you see, I mean, this project delay as a concept is like very very, I mean, like anything that we start, whether we build a bridge or whether we start a railway a new railway thing, or whatever, a
Yeah.
new building, the first thing that comes to our mind is that project cost escalation. Okay.
Correct.
And Brahmastra, what it is facing, okay, the challenges it faced, okay, maybe it was a great movie 3 years ago, but I think post COVID, what has happened is that people have actually seen so many Marvel movies. They have been exposed to international content, OTT content, and all that kind of stuff. So
Correct.
the world has also changed for them. So in many cases, like I think it's an interesting Indian problem that we start off on a project, and by the time we are about to finish, and after that cost escalation, we suddenly find that the world itself has changed with whatever our assumptions were in the beginning. So I think that is the reason I thought that this entire case study of Brahmastra is actually a very very business case out there, and it could be actually for someone who is in business school, or someone who is even a very serious researcher. There is a lot of learning out there. Also, one more point I would like to make is that there is one South Indian film that came few months ago, Minal Maneri. What was it called? That Malayalam movie that came. Uh, okay, it was a superhero movie, and trust me, it was done on a very low budget, and it actually had such a great story, and it had a great story to tell. It was done on a low budget, and actually you could say that, hey Marvel, look, we can do your kind of story far better than you guys, and even at a lower cost. So there is a
Yeah.
learning out there. So I think, one more point I would like to touch is that, say, Anurag Kashyap has been a very good filmmaker, but the moment you give him money, he really
Yeah.
screws up.
He's screws up.
So I mean, like, you see all his good movies, they are very low budget with no superstar, nothing, like, very unknown actors and all. And then suddenly you give him something like Bombay Velvet, okay, where he has all the budget, he has everything, and then he really screws up. Okay, same thing.
You give us 300 to 400 crores, we'll go to Mars, but we won't make a good movie out of 300 400. हम
Exactly.
Mars कौन जाएंगे? We'll go to some.
So I think, probably, what, maybe we as Indians are very good at penny wise. Maybe we should also become, pound, instead of being pound foolish. We should, pound is
Yeah.
not a word we should use these days.
Yeah, yeah. No, I mean, some of us, I think we also getting used to now. My son went and saw it, and he said, "Boss, it was amazing. He loved it," and
Yeah,
he said it was a great movie. I don't know what people are talking about. So I think that generation is liking it, and
yeah,
yeah, maybe it's not going to make too much. I mean, maybe it will not even recover costs this time, but it'll still be a sort of a trailblazer, in its
yeah, yeah. It
and
will happen. It
it
will
will
happen.
go down the line when people talk about these kind of movies coming
Yeah.
from India. This will be the first movie ever that will be talked about.
Yeah, it will. It is a good start. I think, it's a really good start. It is just that I'm just saying that there are a lot of learnings for all of us. It is just not a movie. And I really believe that, entertainment is probably the most serious business out there. And, maybe someday you and I should have a talk on that, because people
Yeah,
treat entertainment as a very light, okay, entertainment business. The entertainment business is a very serious business. The challenges are very unique, and we have to look at it as a serious business, the way the West looks at it. It's soft culture. Bollywood is something that is like, that can actually, we have been very very successful in exporting Bollywood to outside India, and we should treat it as a very serious business. And I think maybe some other day, we should only, I mean, apart from market, we should just talk about this part also.
yeah. I think that's happening slowly with the large studios coming in, and
Yeah,
it takes time
it's
to change
happening.
the
No,
the
no, I
pace of.
don't think. I mean, it's slightly differently, Anish. I think, like, when if your kid comes and says that, मुझे ना हिंदी फिल्म का डायरेक्टर बनना है, and you assume that you don't have anybody from your family,
Yeah,
आपके फैमिली में सिर्फ इंजीनियर्स और डॉक्टर्स ही है, and आपका बच्चा आके बोलता है मुझे मुझे फिल्म डायरेक्ट करनी है. I think your first reaction, अरे यार that is a risky business, that is this तू एक अच्छा सॉफ्टवेयर इंजीनियर बन के गूगल में काम कर ले. You would not tell
Correct.
him, यार why don't you just kind of, why don't you join Pixar, why don't you kind of join one of those Indian big studios or whatever, like, because uh, we tend to in our we even as audiences, even what we kind of, अरे यार ये बहुत risky business है, अरे ये सब क्यों करना है तेरे को. I think it's high time
I
that
mean, like Bollywood, all we say that Bollywood is bad, and you'll get sucked into that culture and don't go there and all that kind of stuff.
it is legit, yeah. It is a very legit business. It has its unique challenges, and we have to look at it that way. Many years ago,
Yeah.
stock markets were actually looked at like that. अरे वो मत करो, वो सट्टा
Maybe
लोगों
today
का
they still
पब.
are.
हाँ.
Today, I mean, it's still, in some sense, it is that no, if you tell somebody that, let's say you're not managing third party money, you just have your own money and there are legit full time investors, who are
Yes,
doing
yes,
that, but,
yes.
and they will be asked this question, oh, you invest in stock market, but what's your real job? Like, you are a
Yeah, yeah,
singer
yeah,
or
yeah, yeah,
an
yeah.
actor, but what's your real job?
But I think stock market has crossed that line. People now, okay, you are a
Yeah,
stock market
yeah,
investor, but it has gone through a lot of pain from the 80s till now. I mean, 80s में अरे वो market wicket है ना, वो सट्टा वाला वो सब नहीं करने का basically. And there was no concept of like trading, investing and all. Anybody who is in the stock market is doing some hera fairy. But from there, it has become a very legit business. Like when now
yeah,
parents are actually training their kids to become fund managers. 12-year old,
correct.
13-year old, like मैं
Yeah,
मेरे
that's
बच्चों को मैं
another
fund
interesting
management बिठा.
story, I think.
What?
I think that's another interesting story about
Yeah, yeah,
that kid.
yeah, yeah. So that is happening. So why I also look for a day when parents say, yeah, I would like to make my son as a superstar in sense, as an actor. I mean, but that
Yeah,
we will reach there. There, you
yeah.
know,
It's a legit career. Even if you don't reach superstardom, you're not going to be,
hmm, yeah, yeah,
uh,
yeah. I mean,
not
like.
going, you're still going to look decent.
Yeah, I mean, like, for many of these fund managers whose parents were working in government and had they just, they were, उनको लगता था कि यार, my son will go and just play in the stock market. But they would have been like shit scared. अरे no, ये सब नहीं करना चाहिए. I'm talking about in the 70s
So
and 80s.
how like IPL now? If you said that your son wants to, or daughter wants to go and play cricket, but
Hmm.
if you don't make it to the Indian cricket team, then it's all or nothing. But now with IPL and with these all these state
Exactly.
leagues and all of that, it's a legit. You have, there is a certain, that you will reach a certain level, and you will make a decent living if you, even if you are not able to get to the, not everybody becomes CEO of the company, not everybody becomes MD or all of that kind of stuff.
Yeah, yeah, yeah. So on that happy note, I think we can.
Yeah, yeah, it's been.
This was great talking to you, Anish.
Thanks, Gil. Sorry to have you again, and we can continue for another hour or so, and we won't stop. But
Yeah, yeah, yeah.
thanks
I
a
know.
lot for coming today.
Yeah,
So,
pleasure, pleasure.
ठीक है, all the best.
चलो, thank you so much.
Thanks.
Yeah,
Bye. Bye.
bye.